So what is stock really? Let's go there. So we spoke about Apple Store, owning the Apple stock and all that. So many of you already own all these kind of things in your 401k accounts, in other accounts, in your Roth accounts, in your IRA accounts, whatever that is that we spoke about, the containers. Okay. So today we will understand what those holdings are from an equity perspective. Stock prices move because buyers and sellers are constantly reassessing what the company is worth. That is why it moves up and down. You might wonder why today is so much, why tomorrow is so much, because constantly we are reassessing what is the value of that share. For example, you go to a market early in the morning when there is fresh tomatoes, like I'm talking from an Indian perspective. You have really fresh tomatoes, you go and buy them, like, you pay a little more, right? And then towards the end of the evening, you go to the store to buy the same tomato. It will be like, probably less because the shopkeeper wants to sell it off, and that is his demand and supply. So what happens is we are reassessing whether we should buy in the morning or evening and buy the tomato, right? That's the same concept here. So the stock prices move because they are constantly assessing it. The S&P 500 has always averaged over 10%, even with all the assessments from 1926. You can cover all the things that happened. Great Depression, 2 world wars happened, 2008 happened, and COVID happened. And 2022 happened, which was even worse. So your returns come from two sources: price appreciation and dividends when it comes to stocks. Okay, we'll get deeper into dividends later, but let's talk about how this is done. Here's the good news. You do not have to pick individual stocks. And I know that some of you are thinking, hey, what about that guy on TV, right? I know everybody is watching, right? Jim Cramer on Squawk on the Street. I'm sure most of you know him. He is like slamming buttons and yelling, buy, buy, buy. Look, Jim isn't entertaining. Okay, I'll give him that. But please do not let a man who treats the stock market like a game show or make you feel like investing is only for loud Wall Street types. It's not. You do not need to scream at the soundboard to build wealth. You just need a plan and some patience. So take a deep breath. We are going to keep this calm and simple. So three terms you'll hear. One is mutual fund, other is ETF, and other is like, index strategy. So mutual fund means pools money from many investors and manager picks the investments. There is a mutual fund manager. He sits and picks the investments. That's a mutual fund. An ETF trades throughout the day like a stock. Okay, usually, it is at the end of the day or at the beginning of the day. It's just like an individual stock. You will see an ETF moving up and down. And index is a strategy. Index fund is a strategy. It tracks a particular index. We spoke about index in the public market basics, NASDAQ, S&P 500, Dow 2000, Dow 5000. It tracks one of that, and you will be having a fund which gives that. So one fund in any concept, whether it's mutual fund, whether it's ETF, whether it's index fund, gives you ownership in hundreds and thousands of companies instantly. That's what you need to remember. Here's a fun way to think about it. If you had put $10,000 in S&P 500 in 2014, it would be roughly 30,000 today, which is how much? Like, we're only talking about 12 years. You didn't need to follow the news. You didn't need to pick winners. You didn't need to time the market. You just needed to invest and go live your life. Okay. So the whole concept is that, you just, if you had done this from 2014 to 2026 today, you made 30,000. So 10,000 in savings account will be about 10,300 or 10,400 in this 10 years. So the market gave you 20,000 more just for being patient. So now that we know what that is, let us look at, what are the things that we consider when it comes to stocks. I want you to know that because that's important. The mutual fund, the ETF, the index fund are just a cluster of all these stocks. So we'll understand stocks better, then you'll understand all these funds better. So that is the whole concept. So let us see what stocks are. We'll be talking about three main things that you will hear today. One will be style, another will be size, another will be sector. These are the only three things that for everything diversification is required. So I want you to know these three things: style, size, and sector. These are things that we are going to talk about. Okay. So the next. Okay. So now that we know what stocks are, there are two main philosophies for picking them: growth and value. Okay. Let me make this real with an apple to apple comparison for you. Same amount of money, same time period, two very different approaches. Okay. Imagine this. Let's take two of our moms, Vidya and Anu. Okay. We'll get them and see what they did. In 2014, Vidya and Anu each invested $10,000. Okay. Vidya picked Amazon because a classic growth stock. I'm going to give you examples of what is growth and what is value. A classic growth stock. Anu, on the other hand, picks Johnson and Johnson, a classic value stock. Okay. Fast forward 10 years. Let's keep 10 years. 2024. Vidya's 10,000 in Amazon grew to roughly 55,000. Okay. In 10 years, Amazon went from 10,000 to 55,000. Amazing, right? But here's the catch. The ride was terrifying for her. In 2018, Amazon dropped about 25% in 3 months. Okay, she bought in 3 months, it went down 25%. In early 2022, there was a big tech crash. Now, just 4 years back, it crashed over 40%. So Vidya watched her 50,000 shrink to 28,000, okay, in less than a year. Just in a year, it happened, okay? So I'm talking about, 2018, 2022, within those 2 years, within that 40% crashed, and Vidya watched her 50,000 shrink to 28,000. She got zero dividends along the way. Every dollar of return depended on the stock to go up for her. If Vidya panicked and sold during any of those drops, she locked in all the losses. It's impossible to get back and make that money. She has locked in the losses. Let's look at Anu. Anu's 10,000 in J&J grew to about 22,000. Okay, 10,000 went to 22,000. Less than half of Amazon's return. So why would anyone pick J&J? Okay, it's a value stock. Why would anyone pick J&J? First, Anu collected over $3,500 in dividends along the way. Okay, real cash in her account every quarter that came as dividends. Okay, like clockwork it came. Second, J&J never dropped. J&J is Johnson & Johnson. Never dropped more than 15% in any single year. It never dropped. Not like Amazon that dropped 40%. When Vidya was watching Amazon lose 40%, Anu was sleeping soundly. Third, this is a big one. If Anu turned on DRIP means dividend reinvestment plan. That's what they call DRIP. So the dividends that were coming to them, if they had put it back into that, reinvested, her 10,000 also grew to about 30,000. So she is actually in par with Vidya without any trouble, without any panic, and sleeping well, doing nothing. The gap narrows significantly once you factor your reinvested dividends. We'll talk about it. Okay. So why does this value stock matter? That's important for you because everybody wants to be in the growth stock, right? Everybody wants to just grow, but you have to also have the stomach to take it. Like when it falls 40%, 50%, 60%, it's difficult. So here's the most part that people miss. Growth doesn't always win. Okay. From 2000 to 2010, if you really go and look back, 2000 to 2010, an entire decade, that was like 10 years, growth stocks actually lost money. Okay, and the dot-com crash wiped out the tech darlings, and growth investors spent 10 years just getting back to even. They took 10 years after 2010 to even get back to even. But value stocks made money during that time. That same 10 years I'm talking about, J&J, Procter & Gamble, Coca-Cola, they kept paying dividends, kept growing earnings, and delivered positive returns while growth investors were under the water. That is why. Same thing in 2022 happened. After all that, again, in 2022, tech stocks dropped nearly 30%. Okay, but value stocks, ExxonMobil surged 80%. Merck gained 40%. And J&J was steady. So if your portfolio was all growth, 2022 was devastating. If you had value mixed in, you cushioned the blow, then value stocks are like the ballast on a ship. They keep you from capsizing when the waves get really rough. So that, which is why value is important. There is also something psychologically very powerful about value stocks. That is when your portfolio is paying you dividends every quarter, real cash hitting your account, you're much less likely to panic sell. Research is there to prove this. Because you get your dividends every quarter, you're seeing this real cash in your account, you will not panic sell when the market falls. Okay, when there is a downturn. That behavioral advantage is worth more than most people realize. It's very important. The best investment strategy is one where you can actually stick with in hard times. And the bottom line, Vidya and Anu both made money. Neither was wrong. But the smartest move, own both. Little of this, little of that. So you have this going. So you understand growth and value now. And a broad index fund that I spoke about will hold all these things. Will hold Amazon, will hold J&J, will hold growth and value side by side. You get the rocket fuel of the growth and the stability of value in one investment. But over a period of time, you will understand how this all works, and then you can also think about you doing the diversification in different sectors, picking all these stocks. So you don't have to choose, but you don't have to guess which style will win less. At least you don't have to. Otherwise, you have to guess, hey, is growth going to do well or value going to do well this year? Have both. So you know that it is, now you know how companies behave, how growth companies behave. We'll also get a little deeper into that so you'll understand better. So that's one thing. So we spoke about growth and value, which is called style in finance. The next one is size. We're going to talk about size. Okay. So value and growth is about how company behaves, right? Now, let's talk about how big they are, because size tells you a lot about what to expect from the stock. It's important that you know both. So think of it like restaurants, okay? Everyone here eats out. So this will click instantly. A large cap company is like McDonald's, okay? Over $200 billion revenues, 40,000 locations, 100 countries, not going anywhere. They've been there around for a long time. They're big. You know exactly what you're getting. There is no surprise there. Same Big Mac, maybe a little bit of fillers inside is different in Mumbai, Manhattan, and Minneapolis. But the Big Mac is Big Mac. Okay. So Apple, Microsoft, Walmart, JP Morgan, these are the McDonald's of the stock market. Okay. Stable, predictable, pays a dividend sometimes, pay maybe not. Some of them like J&J and all that, but they're not going to triple in size overnight. Okay, they already tripled. That's why they are the big, large cap companies. Let's talk about mid cap. Mid cap is 2 billion to 10 billion. This is your Chipotle or Kava. I don't know if you've heard of Chipotle, Kava. I'm going to give you an example of Chipotle because Chipotle has already moved into the mega cap, like the big cap. So it's a proven concept, loyal fan base, expanding like crazy. Chipotle was a mid cap in 2012. Today, 2026, in 2012, they had 1,400 locations. Today, they have 3,500 and is worth over 70 billion. So they came to the large cap. It graduated to large cap. And then Kava, on the other hand, I don't know if everybody knows about Kava. That's the raging food chain now. Went public in 2023. It's everyone's obsessed with that harissa drizzle, right? I don't know if you've heard, if you've traveled, if you've seen. That's like Kava is the next Chipotle, is what is expected. Investors are betting that it's the next Chipotle. That's mid cap energy for you. Exciting, growing fast, real potential to become a household name. Small cap stocks under 2 billion are the hot news spot in your neighborhood. Okay. The place with the line around the block when you go out that your foodie friend won't stop posting about on Instagram. And then it might be become the next Kava. We don't know. We're not talking about being the next Chipotle. It might become the next Kava, or it might just close in 2 years and become a nail salon. Don't know, because that is what small cap does. Higher risk, absolutely. And that's where the biggest growth stories begin. It does happen. I'm not saying that they don't. Small cap are ones that become big. Every Chipotle was once an unknown burrito shop in Denver. Okay, that's how they started. So that time to now, a long time has passed. We know the history, we talk about it. So S&P 500 only tracks large caps. Okay, they don't track small caps and mid caps that we spoke about. Okay, so there's no Kava and there is no small companies like new and all those kinds. They won't be tracking that. So you have to look at a total market, stock market index fund, and go with that if you want little exposure. And it is a good idea to be exposed to all these size of the companies, big, medium, and small. Here's a story that can make it real for you. In 2003, okay, Apple was a mid-cap company. Everybody will agree with me because Apple has grown only now, worth about $6 billion. Okay, so they were in mid-cap. No iPhone, no iPad, no Apple Watch. If you had invested $1,000 in Apple back then, it is worth about $500,000 today, $500,000 today. I'm talking only about 2003. Okay, so Apple then was only a mid cap. But here's the real takeaway: a total market funds already owned Apple when it was small. Total market index. No, I'm not talking about S&P. So an Apple grew from mid cap to the most valuable company on this mother earth. The fund captured the entire ride automatically. You didn't have to guess. You didn't have to pick Apple out of thousands of stocks. The fund did it for you. Okay, that's one easy way of learning, that this is how you get exposed to all these things. If you own a total stock market fund, this is what you're exposed to. You're exposed to the styles. Now you're exposed to the sizes. So we have covered style and size. The third dimension in diversification is sectors, the industries where companies actually compete. Okay, so that is what these are the three things that's important: sectors where companies compete. Okay, the stock market has 11 sectors. You don't have to know all the 11 sectors, but there are 11 sectors. You don't need to memorize any of them, but knowing the big four will give you framework for understanding why diversification matters so much. That's the goal here. So at least know the top four. Technology, that's 30% of your S&P 500. Okay, Apple, Microsoft, Nvidia, Google. The sector has been the market's rocket engine, especially with AI and cloud computing this in the last 2 years. Healthcare is 13% of the S&P 500. This will be United Health, Pfizer, J&J, all this. We're not talking about hospitals. Hospitals are not included in all these things. Hospitals are called themselves non-profit. So this is just healthcare means United Health, Pfizer, J&J, all these pharma companies. People need healthcare whether the economy is booming or crashing, which makes this a very defensive stronghold. Okay, then financials, that is like 13% again. Technology 30, healthcare 13, and then financials 13. JP Morgan, Visa, Goldman Sachs, name any company, banks and payment networks that move money through the global financial economy is another sector. And then consumer and energy. Energy is Costco, Exxon, ExxonMobil, all these things. The things you buy every day and the energy that powers it all is consumer and energy. So I want to give you an example why these sectors matter. Okay, let's go back to the Vidya and Anu who are still sitting with some money and invested and things like that. Let's say Vidya put $100,000 into a tech-only ETF. She loved the ETF. She said, I'm having a great diversification. I love the tech market. So I'm just going to be in tech ETF. Tech ETF will be Google, or you know what it is, tech ETF, all the big companies. So she put that in January 2022. Okay, I'm taking that as an example because I can push a point to you. So she loved all the Nvidia, Apple, all the big names. Okay, by December 2022, you know what happened. Tech had dropped nearly 30%. So Vidya's 100,000 was 70,000. She was devastated. She was like, oh my God, because she was only invested in tech ETF. But Anu, who had the same 100,000, she put it in a total market fund. I'm just giving this example because total market explained you what is styles and sizes and all this. So in the sectors, I'm explaining to you. So that dropped only 15%. Why? Because of fund owned ExxonMobil, which went up 80% in 2022. She owned Merck, that went up 40% in 2022. She owned Costco. She owned United Health, which held steady. It didn't grow much, but it was steady. They never fell. The sectors that Anu owned, that Vidya didn't, energy, healthcare, consumer staples, acted like airbag in a car crash. They didn't stop the impact. I'm not telling that there was no impact. It didn't stop the impact, but they prevented a total wreck. Okay, so she only lost 15% in half of what Vidya lost. So here's a fun way to visualize it. Okay, I want you to visualize this. Walk through your typical day. Okay, what your day looks like. You wake up, you check your phone. You see, oh, what's going on with my phone? That's tech for you. Take your medication every day. That's healthcare for you. Pay for coffee with your Visa card. That's financials for you. Drive to work using gasoline. That's energy for you. Pick up groceries at Costco. That's consumer for you. You're already connected to every sector of the economy. Investing in a total market means you own a slice of the world you already live in. Think about it that way. Okay. So if all your money sits in one sector and that sector crashes, your whole financial plan is in trouble. So, but when you own all 11 sectors, which is done through a total market fund, no single industry can sink you. That's real diversification. We spoke about diversification, but that is the real diversification. So we spoke about style, sizes, sector. Now let's tackle the how. How do you know if this stock is a good day? How do you actually know that, yes, I can buy this stock? Okay. So that is what we are going to talk about next, from the sectors to this. Okay. This is arguably the most important slide today. Okay. So I'm going to spend a little extra time here because you're seeing jargons there. So I'm going to make sure that those jargons are removed. We are shifting from what to the how. How do you know if the stock is worth what you're paying? Okay. This isn't about turning you into a Wall Street analyst. It's about giving you enough literacy to spot nonsense when you hear it. Because you will hear it at dinner parties, in group chats from that one friend who knows a guy. I've heard this, even though I'm in finance, I don't show that to the world, but I know there is somebody talking about one friend who knows a guy who knows it all. Okay. So here's the biggest myth in investing. Okay. That stock is only $15. It's so cheap. Let me blow this up right now. Let me just go and buy that. Imagine two houses on the same street. All the realtors here will agree with me. All the realtor moms can agree with me. House A is listed at 200,000. House B is listed at 500,000. Which is the better deal? You can't answer that without knowing what each house looks like from inside, right? House A might be a tear down with a cracked foundation. Okay. House B might be a 5-bedroom mansion with 700, worth around 700,000. So you're actually getting it at a discount, even if it is like 500,000. Stocks work the same way. A $15 stock with a PE of 50 is actually expensive. What is PE? Price to earnings. Okay. Price to earnings ratio. That's one thing that I want you to learn today, PE. Okay. Because that is how you value a stock. So you're paying $50. A $15 stock worth a PE of 50 is actually expensive. You're paying $50 for every $1 that company earns. Okay, that is the meaning of that. If the PE is 50, you're paying $50 for every single dollar that company earns. Okay, a $300 stock with a PE of 12 is actually cheap. Okay, you're paying only $12 for every $1 of earnings. Price is just a number on the screen. Okay, don't go by what you look at the price. Valuation matters. Okay, valuation will tell you the real story of what's happening. The single concept separate informed investors from people who get taken advantage of. If you know this, you know when you look at the stock or an equity. The PE ratio is a very simple math, okay? Stock price divided by earnings per share. That's all it is. Stock price divided by earnings per share. If a stock is $100 and earns $5 per share, PE is 20, meaning investors are willing to pay $20 for every $1 the company makes. That is the meaning of that. The S&P 500 long-term historical, thing is 15 to 17. I've told you in the second slide, recently it has become too concentrated with tech stocks, and 50% of that is this big seven. So it's kind of, moved 20 to 28 range. But historically, always it had been 15 to 17. We used to look at and we used to say, okay, the stock is good. But now tech stocks, we are looking at 20 to 28. So the S&P's PE ratio I'm talking about is moved. Partly because I told you, the tech companies' growth make up the bigger share of the index. That gives you a ballpark of what normal looks like. Higher PE of 30 to 50 means investors are betting big on the future growth. They are saying that this is the company, so I'm going to pay. So the valuation is much higher. Low PE of 5 to 15, if you see, could mean a hidden gem, okay, or a company in trouble. One of the two. You should know to assess that. Whether it is a 5 to 15 is low, maybe it's a company in trouble, or it's really a hidden gem that you're getting at such a low valuation. Now, you will ask me, where do I find this PE ratio now? You're talking about PE all the time. Where do I get that? PE is nothing but price per earnings. Now, you never need to calculate this PE yourself. Just go to Google. I know every one of you will do this. Just go to Google. Type any company that you want to, you're looking at. Say you want to buy Apple stock. Just type that on Google, and Google will show you the PE right next to that, because that's how advanced we have become. Okay, it will show you the PE right in the summary card. Okay, the other places that you can see is Yahoo Finance is another great free option, and search a stock and the PE is listed in the quote summary. It'll be there right there on the left side. Okay, Morningstar also shows it for free. Everything gives you this PE for free. The point is, the thing is that it is already available. Okay, the number is everywhere. You don't need a Bloomberg terminal or an MBA to find it. 5 seconds on your phone. Let's make this concrete. Okay, Nvidia's PE was 60 in 2024. Okay, in 2024, Nvidia's PE was 60. We are saying it's really, really high PE. Okay, so that sounds insanely expensive. Here's the twist. Nvidia's earnings grew over 100% that year because every company on earth was buying AI chips. Everybody were buying AI chips. So what looked expensive at PE 60 was actually a bargain. Okay, like paying 500,000 for a house that's worth about $700 to $1 million. So meanwhile, a struggling competitor, I'm giving you a competitor in the same thing, Intel, right? Intel had its earning collapsing, losing market share to Nvidia and AMD, cutting its dividend. We saw that clearly that they didn't pay dividend, they didn't do anything. Intel was just losing it, laying off thousands of people. The stock price looked cheap. Okay, it was really, really cheap. But the business behind it was falling apart. You had some of the things, you have it in news. Some of the things probably you have to dig a little deeper to read about why certain stock is really cheap. But that's the tear down house with a great price. Okay, the lesson, PE is just a starting point. Okay, it gives you a little indication. It's a starting point, not the finish line. Always ask again what the number is, what it is. See the number, why it is what it is. Okay, so now you can just pull your phones right now and perhaps look up a couple of stocks, right? Here's what might confuse you. If you had looked up, then this is what will confuse you. If you look at Alphabet stock, the Alphabet stock, and J&J stock right now, I'm taking this example because it's very close PE. I wanted to talk about that. That's why I'm taking these two examples. Alphabet stock and J&J stock right now, you will see PE ratios are surprisingly close. Okay, but somewhere in the mid 20s. I think Google is, Alphabet is about 27, and J&J must be about 25. So wait, what is happening? Why Google and Johnson are completely different companies? One is an AI and advertising juggernaut, growing revenues 15% a year. The other is a 138-year-old healthcare giant that grows 3 to 5% a year, but pays a rock solid dividend. How can they have the same PE, right? So, and this is exactly why I told you PE alone doesn't tell the full story. Okay. The market is paying the same multiple for both, the PE multiple for both, but for completely different reasons. You should understand that it is completely different reasons why the market is paying that kind of PE for these two companies. With Google, investors are paying 27 times earnings. I told you 27 means for every dollar, $27 is the thing. So 27 times earnings, because they believe AI, cloud computing, and YouTube will keep growing fast. Okay, they are buying the future growth. When you buy that, you're buying the future growth. With J&J, investors are paying 25 times earnings because they trust it's a fortress. It's got consistent earnings. It is a dividend that's been raised for over 60 years straight. Okay, products people buy, whether the company is booming or crashing. They are buying safety and reliability. Same PE, different reasons, totally different reasons. If you like two houses listed at the same 500,000, one is a sleek modern condo downtown, the other is a farmhouse in 10 acres. Same price, completely different value propositions. Okay, so you would pick one that is based on what you need in your life, not just the number on the listing. Don't go by the number on the listing. You pick what is important to you at what stage of your life. That is very important. This is why context matters. It's not like I cannot give an advice to buy anything on the phone or by talking, by not knowing where you are in the, we spoke about different chapters of life in different people, right? We don't know what your risk tolerance is to take a growth or a value, right? That's what context matters in more than the number. You compare PE with the same sector, Google versus Microsoft, or compare J&J versus Pfizer, not across totally different industries, like how I did showing you Google and J&J. They're two different things, two different industries. Instead, pick two stocks within the same industry and then you do the study. It'll make more sense to you. This is also exactly why a diversified index fund is so powerful. Okay, it owns everything. It owns Google, it owns J&J, the growth rocket, Steady Fortress, everything side by side. You get the value prop in one investment. Okay, so not have to decide what's the better deal. So I'll be really honest here. Okay, stock valuation, equity valuation is literally an entire semester in our MBA program. Every MBA here will agree they have done MBA finance. That's like an entire semester. But people get PhDs in this because our experts that talk to us on this have PhDs in valuation. So they'll talk to us about all the things. So I'm going to give you a 60-second version of, maybe 2-minute version of what the pros look at beyond PE. Okay. I just want to give you that because you should understand what it is, just so you are aware that all these things exist. Okay. First, number one, price to sales. Okay. This is useful for really young companies and startups. They don't have earnings, so they don't have PE ratio. What do we do? Then this one comes to PS, price to sales ratio. A lot of tech startups lose money for years while growing revenue fast. Okay. So PE does not work when there are no earnings. So analysts will look at PS. Okay. That's one. Number two, price to book ratio. Okay. Compares the stock price to what the company would be worth if you liquidated all of its assets. Okay. What is the company's worth? If it from the book, it just liquidated all its assets. Where does this happen? It happens in banks and insurance companies, okay, are often valued this way. The banks and the insurance companies are valued this way. If your price to book ratio is below 1, The market is saying the company is worth less than the stuff it owns. It's not a good thing. Could be a bargain or definitely a warning sign. That's the message it gives. Next is the peg ratio. So these are all, I'm just going fast because these are too much for you to grab. And it's like PE ratio is just the beginning. I want you to just look at it because it's available all the time, and then you will see only those kind of stocks. You're not going to look at a stock that is not put on the stock market. So these are available. These are valuation techniques to see. So one is the, I told you, price to sales, price to book, and then peg ratio. Peg ratio is PE by growth, okay, divided by the company's growth rate. It adjusts how fast a company is growing. Sometimes a PE of 40 sounds really expensive, but if the company is growing at 40% per year, the peg is 1, which is considered really, really fair, right? Anything under 1 is undervalued. This is how Wall Street justifies paying high prices for fast growers. There are companies that grow really, really fast, and then they go with this peg ratio. The other one is free cash flow. Okay, you must have heard of this all the time. FCF, free cash flow. This is the cash left over after a company pays all its business, all its bills, and invest in its business. How much is actually there for the company after putting out all the expenses to see how it grows, right? Warren Buffett famously focused on this. A company can show high earnings on paper, but have a terrible cash flow. That's a red flag. What does that actually mean? Think of it from a personal perspective. You have your salary is your earnings, right? But your free cash flow is what you have left after your mortgage, after your fees, after your groceries, after your bills, after your entertainment, and all those things. What is left is your free cash flow. If that is not there, if that is zero, then what is the point, right? You're just earning to live. There's no investing here. And finally, dividend yield. Okay, we cover this on the next slide because I want to talk about dividends, but it's also a valuation tool. So you know that. A company paying a 4% dividend, which is what we spoke about Anu's J&J investment, with a low PE might be a rock solid value investment because it's going to pay that dividends. They're all just different lenses for the same question. Is this stock worth what I'm paying? You don't need to master all of them, but now when someone at your group or your dinner table, dinner party just drops peg ratio or free cash flow, at least you can nod and smile and remember me. That's all it is, because those things don't matter. If you know the PE ratio and have the fun, slowly you will learn all these things. We'll start at what it is, but definitely I want you to know these terms, because people talk about it when they talk about when they talk about Anthropic, and when they talk about SpaceX and all this, they'll talk about peg ratio because the way it is growing, right? That's important because there is no PE there. There is no price to earnings ratio there. So free cash flow, how much do they have? Uber always suffered with that, Uber company. So things like that, slowly you will understand. If somebody is dropping those words, at least you will feel happy. Oh, I heard this. I'm good. So here's the good news for all of us. If you invest, you don't need to evaluate any of these ratios yourself. The fund diversifies. If you do it in a fund like a total stock market fund or anything, expensive growth, cheap value, everything plays automatically. All of this is literacy, no call to action. You just need to know enough to not get fooled and to feel confident when you look at your accounts. That's all it is. Okay, so next I want to talk about, that's about valuation. I want to talk about dividends next, because that's something very important that all of us should know, because that's one of my favorite topics, dividends. Okay, this is one of my favorite because dividends feel like magic once you understand them. Okay, you know, in Monopoly, right? That's a game that I have played growing up. I'm sure you all have played at some point in the family. When you pass and go, collect $200. That's a dividend, right? You didn't do anything. You just kept playing the game. And then dividends work the same way. A company sends you cash every quarter for just owning the stock. You literally get paid for doing nothing. Now, if Monopoly also taught other things, like, the cost for that, and we'll all be in great shape, but it didn't do. But it just told us, when you pass, go and collect $200. So we did that and we played it. That's what I want you to relate to when it comes to dividend. Not every company will pay a dividend. Growth companies like Amazon, Tesla pour every dollar what they earn back into expansion. That is why they are growing. They earn the money, they put it back into expansion. They are like that friend who never picks up a check because they are reinvesting in themselves. But mature companies like Coca-Cola, J&J, Procter and Gamble have been paying dividends for decades. They have been paying dividends for so many decades. For many retirees, I'm telling you, dividend income completely replaces a paycheck. So you can imagine what that is. That is, the dividends just keep coming to them. Let me give you a number that will stick with you because it's important. Let's bring Anu back because she's like a value investor, right? So let's bring her back. Anu had put $10,000 in Coca-Cola stock in 1990, okay, back in 1990, and just held it. She did nothing. She just held on to that Coca-Cola stock. She just got a bonus in 1990. She decided she's buying a Coca-Cola stock and kept it there. That investment would be paying her right now $4,700 every single year in dividends. She'll be getting that 4,700. She didn't do anything more. She just put 10,000 and she sat with it. Okay, in 1990. Every year she's been getting $4,700. That is almost half of the original investment. Okay, that she made back every year like clockwork while still owning the stock. She just holds it without reinvesting any dividends. She got that money, and without reinvesting any dividends, the stock is worth about $100,000. So that's another thing. But other than that, she's been getting a check every year of $5,000. That's a lot. Here's where it gets incredible. If she had turned on the drip because she didn't want that dividend reinvestment, instead of taking the cash, her account would have automatically bought more Coca-Cola shares with more dividend payment. Okay. Those new shares would pay their own dividends. Those dividends would buy even more shares. This is compounding on steroids. We kept this compounding on steroids for that. That same 10,000 with drip, she'll have over 250,000 today. Same stock, same time period, no additions. The only difference was checking one box in her account when she was opening that reinvest my dividends. Two terms worth knowing in when it comes to dividend. One is dividend yield, which is the annual dividend divided by the stock price, tells you the interest rate of owning that stock. Okay, and dividend aristocrat. I want you to know this because people will talk about it. Dividend aristocrat are the royalty of the investing world, which means why are they called the dividend aristocrat? Because those companies have raised their dividends every single year for 25 plus consecutive years. For 25 plus years, their dividends just kept going up and up and up by a little. They kept giving the thing. So if it was 3%, then it went to 3.25, then it went to 3.4, then it went to 3.5. They are called the dividend aristocrats. Okay. So Coca-Cola has done it for over 60 years straight. Okay. That past recessions, wars, pandemic, crash, everything put together, they had raised the dividends every single year that they paid. That is some kind of a serious commitment to shareholders. Okay. Here's ones you might not expect. Let's talk about Smuckers. Okay. Smuckers is in our own backyard. So Smuckers, you all know that it's a jam and peanut butter company. Okay. Is not a dividend aristocrat, but it has also given 25 years of consecutive increased dividends. It kept giving dividends, but it is not a dividend aristocrat. They bought Hostess Brands in 2023. I think everybody must have heard about it. The company that makes Twinkies and Ding Dongs for $5.6 billion. Okay. So now every time someone buys a Twinkie, Smuckers shareholders will get a piece of that, right? That's what I told you. Boring company, but delicious dividends. Both pay dividends. Coca-Cola, the difference. Coca-Cola is what we call ultra consistent. Through recessions, through pandemics, through everything, they kept increasing and kept paying for the last so many years. Like that, we have P&G, we have other companies too. Smuckers, on the other hand, pays, but not with the same level of consistency. Okay, so that's why they are not the aristocrat dividend. Although they have been paying, they have not been consistent enough. Always in our own friend circle, we see, right? Dependable, always on time friend is like Coke. Okay. Smuckers is like reliable, but not as predictable. We don't know. Like, they may pay, they may not pay. With all their new acquisitions and things like that, things go up and down. So that is what it means when it comes to dividends. Okay. So the next one is, we covered stocks versus bonds in session 2, right? So this is just a brief but important reminder for you. Think of your portfolio like the dabba again. Stocks are the spicy, flavorful items that give you energy and growth. Bonds are the rice, steady, reliable filling. You need both for a balanced meal. We spoke about that. Here's why the mix matters. It's important, okay? In 2022, the stock market, I'm going very recently because everybody knows about this. Stock market dropped about 20%, while bonds only dipped about 5%, okay? 5 to 6%. If you had 100% in stocks, you took the full hit, okay? But if you had a 70-30 mix, when I say 70-30 mix, it means 70% stocks and 30% bonds. 70, your overall portfolio only dropped 15%. Okay. That difference might not sound like much when I say that, but think about a $500,000 portfolio. Think about a 500,000 portfolio. It's a difference between losing 100,000 and losing 75,000. It's big, because not just going to be in only thousands of dollars. It just reaches $1 million at some point, and then this is huge. So most importantly, the smaller drop meant you were far less likely to panic and sell everything at the bottom. The bond cushion isn't just about returns. It's about giving you the emotional stability to stay in the game for the long run. Okay. That is why it matters. General guideline. I wanted so many of you on this thing asked me every single time, again and again, how do I invest? Where is how much I should put in stock? How much I should put in bonds? It basically depends where you are on the horizon of, whether to closer to retirement or not closer to the retirement. But here's the thumb rule, okay? Subtract your age from 110 used to be before. 110, this is what you will see when you Google and see, but it is 120 now. In the last 2-3 years, I told you everything has kind of, got mixed up with this all the things, the stocks and the S&P 500 and everything being a little bit more concentrated. Even this has got to say 120. So here's what I would say. Subtract your age from 120 to get a stock percentage. A 35-year-old might hold 85% in stocks and 15% in bonds. Plenty of growth runway with a safety cushion for them. A 60-year-old approaching retirement might shift to 60-40, okay? Protecting what they have built while still growing. 60, 120 minus 60 is 60, so 60% stocks and 40% thing. Before it used to be 110, they would say 50-50. But it's okay today because it's still like the stocks are not, I spoke about the value stocks, right? If you hold them, they are real safe. So a target date fund does this rebalancing automatically. What is a target date fund? Which is why they are so popular in 401ks, okay? So target date funds are nothing but they know your retirement, when you want to retire, you put that accordingly, they will do this calculation as to, whether it should be 60-40 or whether it should be 70-30 or whether it should be 85-15 or 80-20, depending upon your age, because you've given all this information to open a 401k. That is why you get a target date fund. So we'll go much deeper into bonds, interest rates, risk management in the next session, where we are deep diving into bonds. For now, just remember, equities are the engines that drive your wealth forward, and bonds are the brakes that keep you from going off the cliff. So you need both of these in your dabba. Okay, so let's just put together all of what we learned today and talk about how to actually build your portfolio. Okay, putting it all together. This is where everything comes together. We have covered what stocks are, growth versus value, sizes, sectors, valuation, dividends. Now let's build the actual portfolio step by step. Okay, no guessing. Step 1. Start with a total market ETF or mutual fund. Okay, I'm just giving you this because it's easier for you to learn. Okay, One fund gives you instant diversification across thousands of companies, all sizes, all sectors, all growth and value automatically. Step 2, use your age to guide your stock to bond portfolio. Remember the formula, 120 minus your age equals your stock percentage. Step 3, dollar cost average. Invest the same amount every month, rain or shine, regardless of what the market is doing. Consistency beats timing every single time. You have to remember that timing timing can never match the time in the market. The time in the market always beats the timing. Okay. So let's follow a real scenario. Okay. Meet Jyotsna. She's a mom from our group and she's aged 30. Okay. She is earning $150,000 a year. Let's put that and see how it is. She sets up an automatic investment of $1,000 per month into a total market fund. Okay, through her whatever account, IRA, whatever. Let's assume IRA. She doesn't watch the market. She doesn't read stock tips. She goes to her temple on weekends. She enjoys her time with her friends over the weekends. She goes with her family for outing. All that she does. She just lets the money go in every month like clockwork. $1,000 every month. Joe puts it into her thing. At an 8% average annual return, by age 60, Joe has $1.5 million. Okay. So Joe is 30. Okay. And at age 60, Joe has $1.5 million. She put in only 360,000 of her own money. 1,000 into 12 into 30. That's all I did. 360,000 of her own money. The market gave her over 1.14 million for free. Okay. That is 30 years of patience turning into wealth. That is what I tell you. Patience. Sit in the market. Don't panic. It's okay. Things have always recovered. Okay. That's what it is. Step 4. Consider a target date fund. If you think that you don't want to deal with all these things, it will be named by the year you plan to retire, like a target 2055. It automatically shifts from aggressive to stocks to safer bonds as you get older. Set it and forget it. It will just grow. Step 5, automate your contributions and rebalance regularly. Okay. Automate your contributions, dollar cost averaging. We spoke about how Joe is putting that $1,000 every month, come rain, come shine. She does it. So she's able to see that $1.4 million in her account. So automate your contributions and rebalance it regularly. What is rebalancing? I really want to spend some time on rebalancing because it's one of the most common questions I get all the time. And most people don't understand why we have to do it, why we rebalance. When we first set up our portfolio, you think that you have done this. I told you step 1, step 2, step 3. You decided you are, say, 70% stocks and 30% bond. Okay. The mix was based on your goals, your timeline, and how much risk you're comfortable with. But the market doesn't sit still. Over time, some investments grow faster than the others, and your portfolio drifts away from that original plan. It's not going to be the same. Rebalancing is simply the process of bringing it back where it should be. Okay? So why does it drift? Think of it like a garden. It's more easy to understand it that way. You plant mint leaves in 70% of the beds and cucumbers in 30% of your bed. Okay, in a 100% area, you put 70% for mint and 30% for cucumbers. The mint grows like crazy. Everybody knows that. By the end of summer, they have taken over. You only put 70, but they took over like 90% of the garden. They went and the cucumbers are crowded into a small, tiny corner. Your garden drifted. That's called your garden drifted. You didn't change the plan. Okay. The nature changed the plan. So the same thing happens with your portfolio. From 2019 to 2021, I'm just explaining in small concepts so you can get it. Stocks surged while bonds remained flat. Someone who stayed 2019 with a careful 70-30 mix could easily have drifted to 85-15 by late 2021 without doing a thing in the account. Okay, that sounds great on paper. More stocks, more growth, right? But here's the problem. When 2022 downturn hit, the person had far more risk than they ever intended to. They never intended that. They always wanted a 70-30. But portfolio was now behaving like an aggressive portfolio. They were taking risk they never signed up for. That's not fair. That is what rebalancing is all about. So let's just, what happens, we'll just go over the number here. Let's make this a real deal with two of our moms, right? Both start January 2019, same, Vidya and Anu. Okay, they start January 2019 with $500,000 in a 70-30 stock to bond portfolio. Vidya never rebalances. Okay, by the end of 2021, stocks have surged and their portfolio has drifted to 85% stocks and 15% bonds, worth about 750,000. Okay, the price went from 2019 to 2021. The 500 became 750,000. Her stocks also from 70-30 moved from 85 to 15 because they all grew. Feels amazing. 22 hits. The stock market drops 20%. Vidya is now 85% in stocks. Her portfolio loses 127,000. She is down to 623,000 from 750,000 and panicking because the drop feels much worse than what she expected. She thinks in her mind she's 70-30. It is not 70-30 because in the last 2 years, it became 85-15. So you need to constantly look at that every year, at least once, to see if you're still at that 70-30. Anu, on the other hand, rebalances annually. Every year, she trims the stocks that have grown beyond 70% and moves that gain into the bonds. Okay, by the end of 2021, she also has 730,000, slightly less than Vidya because they sold some stock winners along the way, but her allocation is still 70-30. When 2022 hit, Anu's portfolio only dropped $100,000, $27,000 less than Vidya. More importantly, Anu had locked in some of those stock gains by moving them to bonds earlier. The emotional difference here is enormous. Okay, Anu expected this level of decline. She said, okay, market is dropping this. This is how my portfolio should drop. She expected that. So her plan held. She slept at night. She never had any problem. If you don't rebalance, this is the problem. So the mechanics are straightforward. When stocks have a great year and grow beyond your target, then we sell some of the winners and use that money to buy more bonds, whichever is underweight, right? When stocks drop, bonds hold steady, we do the opposite. Sell some bonds and buy more stocks while they are on sale. That's how to look at it. Notice what's happening. Rebalancing is forcing you to buy low and sell high, which is what every one of us want to do. Rebalancing does that. It buys low and sells high automatically. That is the exact opposite of what people do emotionally, right? Think about it. Most people want to pile into stocks when they are soaring and bail out when they are crashing. Rebalancing moves that emotional trap from the equation. Okay, that is what rebalancing does. It's powerful. It's not about maximizing returns. In a market that only goes up, you would actually make more money by never rebalancing, just letting stocks run forever. But markets don't always go up. Okay, they crash, they correct, they surprise. If you go to the first one I spoke about, foundations, every year it has got at least 1 to 2 corrections. Every 3 years there is a bear market happening. It always happens. You can go back and check in history. Just rebalancing is about making sure that when the inevitable downturn comes, your portfolio is positioned where you really wanted it, not where the market randomly pushed it. Okay, it's risk management, plain and simple. And that's exactly what I'm here for, to tell you about the risk, educate you on the risk. Okay. So here's the hardest part of investing. Okay. And it has nothing to do with math. It's your emotions. In March 2020, when COVID shut down the world, market dropped 34% in 1 month. Millions of people panicked and sold everything. Okay, they locked in devastating losses. This is not far away, just 6 years ago. But here's what happened next. In December 2020, just 9 months later, the market was at all-time high. Okay, everyone who stayed the course without selling got their money back and more. Okay, everyone who panicked and missed one of the and sold missed one of the fastest recoveries in the history. That's what happened. Match your investments to where when you need the money. Okay, long term money, your retirement is in 10 years or 20 years or 30 years, can handle equity risk because you have time to recover from any crash. Short term money, your emergency fund, a house down payment in 2 years, should never depend on the stock market. And look, I know some of you have seen The Wolf of the Wall Street, right? It's a movie, right? Great movie. Leonardo DiCaprio and DiCaprio and Margot Robbie. That chest thumping lunch scene, I don't know if you have seen that, very entertaining. But I need you to understand something. That movie is a cautionary tale, okay? Not a tutorial. It's only it's a caution. So Jordan Belfort, if you don't know, just can Google him, went to prison. The person who gave him their money lost everything. All the people that gave him the money lost everything. Real investing, the kind that actually builds wealth, looks nothing like that movie. Okay, it's like Joe. Actually, we spoke about the mom Joe, right? It's like that, setting up $1,000 automatic transfer every month and then going to brunch and enjoying herself. It's boring, it's unsexy, and it works. Okay, nobody is making a blockbuster about holding a stock market index fund, have they? They will never do it. But those are the people who end up millionaires. I'm telling you, people like Joe will end up millionaires who will do this, forget it, and keep putting every month into the same thing. So please ignore hot stock tips from social media. That's not going to work. And WhatsApp groups or that cousin who just discovered crypto. No, the market rewards boring, consistent, diversified investing, and it always punishes gambling. Okay, maybe not now, maybe 5 years from now, maybe you have more money to overlook that gamble. That's another point altogether. But market will punish gambling. Okay, so yes, let's wrap up with your equities playbook. Key takeaways to carry with you. Okay, so let's see, what is that? Okay, so yeah, this is the one. 4 takeaways for us. Your equity playbook. Think of these as the corner of your finance foundation. Okay. 1, own equities through ETFs, index fund, mutual funds, whatever you're comfortable with. One fund, thousands of companies, instant gratification, diversification. You do not need to pick winners. Remember, a total market index fund already owned Apple when it was 6 billion mid cap and captured the entire ride to the valuable company on earth. So fund did the picking for you. That's number 1 that we took away. Number 2, diversify across sizes, sectors, and styles. Remember Vidya and Anu, growth and value each shine in different decades. Remember Anu owning all sectors, protected her when tech crashed. A total market fund handles all of this automatically. Number 3, understand basic valuation. Don't be fooled by a stock's price tag. Remember the house analogy. A $15 stock can be expensive and a $300 stock can be cheap. The PE ratio is a starting point. Number 4, dividends, patience, and compounding. Sorry about that. Number 4, dividends, patience, and compounding are your greatest friends, allies. Okay. Remember that $10,000 in Coca-Cola? that turned into a $200,000 with the DRIP. DRIP is dividend reinvestment plan. Remember, Joe, $1,000 a month that became $1 million. Math works. You just have to trust it and not panic. Okay? I want you to hear this. You now understand more about investing than most people ever learn in their entire lives. That's the truth. This is not an exaggeration. The knowledge you gain today is power, power to make better decisions for your family, for yourself, to see through the hype and noise, to build real lasting wealth. Remember the key message from the very beginning. Equities are ownership, but you do not need to pick individual winners. Won't broadly automate, let time do the work. Okay? So I want to give you an assignment. I've never given you an assignment. I've been teaching you, right? This is like probably 50 minutes total. First, open one of your investment account that you already hold, you have already. Brokerage account, IRA, whatever, log into it, 401k, and look around. Number two, identify one diversified fund there, equity fund. Look for a total market index fund or a target date fund that matches your retirement year. Number three, check two things about that fund. What does that own? Top holdings, and what does it cost? Okay, that's important. You are in great shape if you know that. 3 steps, 3 things, 15 minutes, and you'll walk into session 5 with real momentum and confidence. So next session will deep dive into fixed income, the risks in bonds. Keep asking questions. Keep talking about money with people you trust at the dinner table, with your spouse, with your kids. Financial literacy is a family sport. I want you to play that game well. Your family's financial future will be in great hands once you know the game well. Thank you all. Ready to take questions. See you at session 5.
Thank you so much for that very educational and informative session. Padma, you're always the best. You simplify the concepts. So moving on to questions in no particular order. The one question from Amam is, what about negative PE? For example, Rocket Lab, RKLB has negative 330 PE according to Google.
Yeah, so it gives you the answer. There is negative PE means the company is either going to be it's really doesn't have the funds. Maybe that is doesn't have the earnings to see that. Maybe the other valuation factors have to come in to provide. I spoke about 4 other valuation thing, and that's where it comes into picture to see if the earnings were not the right metrics to find your valuation.
Thank you, Padma.
For that company, it will be the peg. But yeah, we can talk about it if you really want to talk about that.
Thank you. Next question. Is there a slide for price to sale, book, and peg pointers that you discussed?
Is there a book, you mean?
No, is there a slide? I think they mean in the presentation.
Not really, because I'm only talking about introducing PE ratios first. So I just covered upon the other things. They are all huge topics by themselves.
Yes.
If somebody is interested, we can always come back once we do all the basics and go deeper into all that. Valuation alone can be a 1-hour session or more than that.
Thanks. The next question, similar to the same RKLB ones on the same lines. If it is loss, does it mean heavy investments? I mean, for something like RKLB.
Yeah, maybe there's a huge capex involved. Maybe there is a lot of other things going on, which other valuation factors might bring up to light. If we can look at other valuation things, factors that we spoke about, maybe a free cash flow and all those things, then we can actually decide what is going on with that particular company.
Okay.
Where does it fall? Whether it falls in a small company, whether it is like where does it fall in style? Where does it fall in sector? Where does it fall in size? Then we can talk about what valuation will that be.
Thank you, Padma. This one is an interesting one. Can you please share some good value and growth stocks? 5 examples in each category. dividend yielding ones with 5 to 10 years plan? Do we use Robinhood for the same or any other good platform? Which stock will pick or suggest to invest in the name of kids and good time to introduce this to them? And how do I check how much dividend that particular stock will yield? Where can I check for dividends?
If it is for a kid, we are having a very different conversation. That means the runway is really, really, really long. So we can talk about growth stocks for the kids that are going to hold for the next 50 to 60 years. We don't have to talk about dividend stocks for that matter. So it entirely comes back to who is going to own that, whether it's dividend stock, whether they need it for the income or whether they need it for safety, whether they feel reliable, what is their risk appetite. These are things that needs to be answered before giving the stock list or the where to invest in, because that becomes really, really important. Once we go through the planning portion of the retirement, which I intend to do on one of the sessions, it is important to understand where we fall on that spectrum, whether we are high risk people, high aggressive people, high return, we understand risk, or we are somewhere moderate, we are somewhere very, very aggressive to very, very conservative. Where do we fall on the spectrum? That becomes really important to decide what to invest in.
Thank you, Padma. The next one is, how do we evaluate IPOs without going deep into SEC statements?
That's a difficult question, because IPOs already, you don't have any public record available to evaluate the investment. What you're reading is only news, what you have. So there is no public documents for you in any way to assess an investment. So I would say IPOs, since it's not a public document, we cannot have information unless somebody is working and somebody is giving you some kind of information. But we value IPOs differently with the prices that come in, whether it's worth it, that's a different valuation.
Thank you. And this is a same or similar two questions that two moms have. Reinvest in same company or different companies, and how do you go about reinvesting in DRIP? I think it is a DRIP. So, and another mom has a similar question that I had the same question: if we can reinvest automatically and how?
Yes, you can reinvest automatically. There is a little box that you have to tick when you open the account where it says, should we reinvest the dividends or do you want it in cash? You tick that on, then it automatically reinvests. If you don't, you get a check every quarter.
Okay. This is a very interesting question. I don't know if there's a straightforward answer to this, but I'm curious myself. When do you introduce this stuff to kids?
Kids are more smarter than we think. Okay. We have come to this country so late as immigrants and, trying to find a way. This is one single thing that I think you should give the kids. I think it's high school is the appropriate time to introduce them to investing, to introduce them to the concept of return and risk. And in my mind, I think it is because I work with a lot of high schoolers, and I find that they can absorb the material really, really well. They understand how to value if you teach them how to do it. Because I work with high school kids, I am aware that high school will be a good time for the kids to start looking at the concepts of finance.
What a great answer. I wasn't aware of that myself, so it's very useful to know. And how late is too late to start investing?
Yesterday is the best day to start investing. Okay, for kids, I can say maybe once they start earning or when they get, I usually bring up this practice to all of the clients that I work with, that their children should have birthday money given to them, like $1,000. I insist. And even if they lose, it's okay. It's a birthday gift for them, but they should work real time, understanding what it is. They come back, talk about why such a certain stock is too good for them or they like it. And then we talk, they come back and forth, understand it. Even if they lose a little bit, I let them lose. But that's how they learn, right? So any time is an early time for us. If you're asking about moms, yesterday is a good time.
What a fantastic idea of giving them birthday money and
Yeah.
having those discussions.
It's
And
worked
this is,
really, really well. It's
yeah,
like,
and this is a
all these
great,
kids are very smart, savvy. They come back with the correct questions. They ask because they see the real money going up and down. So they have questions. And the parents don't involve emotions into that because it's just the birthday money.
wonderful. So yeah, that's a great idea. I'll start implementing it. The two birthdays have passed this year, but next year.
Yeah.
How does geopolitical situation affect the predictability of investing in stock market? How can one shield against these unpredictable changes?
In the last 1 year, I think geopolitical tensions have always created a lot of volatility in the market. It goes up, it goes down, it goes up, it goes down. Just go back to being patient. Don't react until it is really like something that you have to act upon, which is on one particular company or something that you're holding. Otherwise, just stay calm, stay patient, put your money in, and it will just work. There's no better example than this year. It has been like really going up and down like crazy, but overall, it has gone up. If you asked me 5 years ago, I would have told you a different answer. But today, I'm telling you, volatility is something that is happening on an everyday basis. And historically, the money has always gone up in 20 years, in 30 years, in 10 years. So don't let these big noise trouble you right now. Just keep investing and keep doing what you're doing.
Thank you. I'm going to skip over the next question because it's a very similar question, but I'll read it anyway, but you've already answered it. What to make of the current unreasonable fluctuations in the market, which is the same as the geopolitical one. So moving on to the next question. Should we rebalance every year or after a major shift in market?
You cannot do it after a major shift in the market. That is exactly when things have moved. So do it every year. Take emotions out of the whole thing. Just make sure that you rebalance every year. Once a year, rebalance and move on. If you really think there's a big market shift that happened, it wouldn't if you are invested in a diversified portfolio. But if it does, then you can think about rebalancing at that point of time. But rebalance, since the question is should we rebalance every year or a major shift, every year is the answer.
Thank you, Padma. I think it would be great to have just like we have family game nights, a family finance planning night every year and do all of this. Next question is, can you talk about bills also and provide some insight?
Bills?
T-bills, sorry.
T-bills, treasury bills is nothing but your emergency funds that have to sit for 2 to 3 years. I told you, when you need money, we put it in T-bills. T-bills are the safest investment in the Mother Earth. There's no other thing that can compare to T-bills when it comes to safety and reliability and the rating. We'll be talking about this fixed income deep dive next week.
Great.
So we will be talking about all these things. Credit rating. What does it mean to be a triple A? What does it mean to be a double A? What does it mean to be a A? So T-bills are the most reliable safety investments out there with a less return, but very safe.
Wow. I'd be very interested for that. We'll all be very interested for that session. The next question is, can we change to, I hope I'm saying, is it DRIP or DRIP? But anyway, DRIP
Yeah.
option if it wasn't done to begin with.
Yes, you can. Anytime. Just enter, log into your accounts, go there and say, please reinvest my dividends. I don't need it. So it just goes back to investing it.
Thank you, Padma. This is not a question, but a comment that I would like to read out to you because all the moms here, I'm sure, echo it. You are excellent in your knowledge, delivery, and practical analogy. I'm sure we all vociferously agree with that. Thanks.
Thank you, guys. That made my day. Thank you so much. That's the goal.
The next one is, thank you, Padma. Can you please send us the homework assignment that you mentioned?
Should I send it? Okay, I will send it. I will give it and then we can put it in the group.
And there's a very nice closing compliment from a mom. Thank you so much, Padma, for this very informative session. A great session as always. And now I'm in a position to understand when my hubby talks about stocks and bonds.
Cool.
Yes.
That's the goal. Every
Yeah.
one of us should have that. You should be talking about stocks and bonds to your hubby. No more hubby talking to you. That's the goal, actually.
Excellent. I think I'm in a position to correct him on a few things, and let's see how I can tiptoe around the ego part, but that's a different issue.
There's no ego between the two of you. Come on. It's okay.
No, there isn't. He's a sweetheart, but yeah.
You know what? I'm really, really happy because you all wanted to start this session at 9 p.m., which I thought is really late. And now it's 10:30 and people are still asking questions and interested and being around.
There is no
Yes.
rush
That's
to
something
get
that
back.
tells me volumes.
Yeah, there's also no rush to run back to give dinner and wrap
Yeah,
up.
that's true.
Yes,
Yeah.
yes.
And your session has been so interesting. I'm sorry to interject, but I mean, technically, I think most of us can go on for another hour because of how well you've been teaching us.
Oh, thank you so much. Really, thank
Yeah.
you.
No, it
But I
was
really
fun.
want you all to go back, reflect, re-see the session if required, and ask questions if required. Just you ask. That's all I need. I want the moms to ask me questions.
Yes. Perfect.
Yeah, so we reached the end of the questions. As always, Padma,
Yeah.
what an interesting, spellbinding. I felt like I wasn't bored for even a minute, and I would learn so much in your such a
Sure.
practical and pragmatic way of explaining things to us.
Oh, thank
And
you so
you
much. Yeah.
made it so easy to understand. And thank you so very much.
Thank you so much. Thank you, everybody. Thank you for your time. Thank
Thank
you
you, Padma.
for, asking questions and keep asking. I'm always there for you moms, okay? Just
Thank
that I wanted to put a little disclaimer in the beginning because I don't want men calling me because this is for women. I want you all to ask me all questions. It's okay if you're learning from your husbands and you ask the question. That is still happy. I'm still happy to do that, okay? That's
you.
something that I want to leave you all with.
All right.
Thank you.
Okay, I'm going to
Yeah.
stop the recording now.
Thank you.
Thank you, Padma.